Hello and welcome to Weekend Investing Daily Bytes. We are shooting episode 345. A day after the budget, the market is still reeling under the impact of Adani group of stocks. Adani stocks still falling very, very hard. Adani Enterprise down 30% almost. Many other Adani stocks still hitting the lower circuits. This remains a big overhang on the market, and until this gets resolved in some way, I doubt if the markets will have the gumption to go up. But minus this factor, I think the budget was well absorbed, and the markets would have gone up. I'm assuming if this play did not happen in the markets. So today's topic is about the index journey of the last 42 years of data that I have from 1979. And I'll just walk you through the chart, the different phases of the market that have come and gone. And we'll try to draw insights and lessons from this vast amount of period of data that we have, and how it reflects on how we sometimes forget about the entire nature of equity markets, which is to constantly keep challenging you, constantly test your endurance, constantly test whether you have the resolve to last through the volatility or not. Today's session, you can see here, market opened around 17,500, about 100 points lower than previous session. This was the budget day, the volatile move from 17,950 to 17,350 and closing around 17,600. And today we opened lower, jiggled around 150 points for most of the day and closed right here. So inside candle for the whole day, and once we break this on the higher side or the low of the budget on the lower side, I think the volatile move can come in either direction. But as I said, this Adani issue needs to be resolved somehow. State Bank of India today has said that they have some 26,000 crores of exposure to the group, and I think State Bank itself has lost more than 50,000 crores of market cap on this fear. So there's while there may be valid reasons for stocks to come down, but there are also fear mongering that is happening, which is causing uh, maybe accentuated moves in some of the collateral damage that we are seeing. Metal stocks, very surprisingly, have gotten shaken up despite the expectation that the China Open will uh, cause these stocks to have good support. Metal stocks down 4.4% today. It's a very sharp cut. Energy, of course, continues to reel down minus 2.3%. Commodity stocks in general down minus 1%. Public sector enterprises, for the lack of divestment news, disappointed by the budget, down 0.8%. Some other sectors within minus half a percent to plus half a percent. PSU banks making a slight comeback towards the end of the day. Initially, they were down 1.5%. But IT, on the back of good Nasdaq moves and uh, positive cues in the tech space, up 1.8%. And FMCG was the major defensive sector where liquidity was flowing to. So big names, I'll show you in the heat map from the FMCG space, gaining ground there. So risk off sort of trades happening here, money moving into defensive sectors, and risk sectors have been slashed down today. Small caps maintaining a slight green edge at plus 0.44%. Mid and small cap index also 0.256%. All the large cap and CNX 500 indices in the negative territory. Nifty Next 50 also minus 0.23%. In the weekend investing small cases, we had NG 50/50 gaining plus 1%. So gold has been doing well, and NG 50/50 with the impact of gold is doing well. Mi EverGreen also, with the impact of gold, is gaining some ground. India top 10 also did well today at plus 0.75%, and the others were in the plus to minus quarter percent to half a percent range. Heat map for the day. Big winners: ITC plus 4.76%, huge mover, new all-time high. Britannia plus 4.6%, huge mover. Levers plus 2.3%. So FMCG space takes the cake for the day. Within the banking space, you had losers in HDFC Bank, also in HDFC Life and HDFC Limited. You had big losses. Bajaj Finance also down. IndusInd Bank was the odd one out here at plus 3.2%. IT space, as I mentioned, up 1 to 2% overall. Extremely good uh, tailwinds here. And some correction in consumption stocks, Asian Paints, Titan, mixed bag in autos, and some losses in NTPC, Power Grid in the power sector. Adani Enterprise, of course, is the major problem area in the distribution and transport space. Adani Ports minus 6% and Adani Enterprise minus 26.7%. ONGC Coal India also losing some ground along with Reliance. So let's go to the trend of the index. So I have all these various periods starting from April 79 till 2023, where I've classified them into segments where market was largely range bound, market was trending up, or market was trending down. These are the sort of the three segments that we've decided segmented the entire move from. I'll show you on the chart, which will be more clear as to what happened when. Let's move to the chart. I think, let me just pull that up. uh, yeah, I hope you can see the chart on my screen as well as this table here. Let me make this bigger if possible. Yeah, so you can see that we started here in 79 with a 15 months of a ranged market. So when I'm saying a range, it means a range market like this. And then post that, we had a nice trend which lasted for about 18 months. So 18 months trend from, let's say, going from here to here. So essentially what I want you to get out of this is how quickly you know the ranged move morphs into trending, and from trending it morphs trending up, it may morph into a trending down. And it has happened very almost a cyclical fashion. So ranged markets here, then you have a trend up where we gained almost 94%. After that, from 82 to 84 mid, we had a 31-month range again here. So, again, there's a long range here that has taken place going into, 1984. And then you have another breakout, which amazingly takes up the market 163%, within a span of just 18 months. So 31 months of range, which is almost 3 years, and then 1.5 years of trending up at 163%. Then you have a virtual a trend down for 24 months from here. Sorry, it goes up 160% within a matter of just 18 months, and then you have 24 months of down period here. So you can see how quickly a bull rally here has morphed, made a top, and a beautiful downward trending line that's coming down here till about 1988, and then again a 16 months of rally going towards 1990. So extremely fast changing in terms of the number of months spent on the down. So 18 months were up, then you had a 24-month down period, then you had a 16-month up period, then you had an 11-month range between 89. So you had a range here, which you basically market was resting and absorbing. And then just see how that major uptrend came in 1990, uh, going from Feb 90 to October 90. So you had, an uptrend of almost 95% here, and then a huge crack of 40%. And then immediately after that 40% drop, you had a 380% rise. So, I mean, if you study the history of the market, uh, markets will go up, when you are least expecting them to do so. I mean, after this 100% gain and then a 40% drop, I mean, how many would be expecting that in the next 15 months you will be 400% up? It's almost impossible to guess that. Of course, the market was opening up, the economy was opening up, and hence a lot of um, uh, first time foreign money was coming into the market. And then markets cracked by 53% till April 93. So, you went to from about 661 to almost 45, 4600. And then there was a sharp crack of nearly 53%. After this sharp crack, this was the Harshad Mehta peak. After this sharp crack of 53%, which took just 1 year, how many would be expecting that in the next just 16 months you will again double? So in the next 16 months you have again gone back to the same level where you had peaked, and essentially retested this this top within 16 months of coming to a sharp low which was almost 53% lower. So after 53% you went into a 116% move up. And then you had a long range, then you had a 5 year period where the market was essentially consolidating in a range uh, before. And I would also call this also to be a range till about 99, before the dot com uh, rally that happened. It marginally went above the previous highs, but then it cracked immediately after that. So this is a rally that did not sustain here. After a 5 year range, when it broke out, one would expect that a much more larger move will come, but that did not. The dot com rally, uh, because it was not broad based, it was only focused on select group of stocks. It did not reflect in the index as much. And then within a span of just 19 months, you had a 58% drop here. So, of course, the volatile nature of the markets in those decades was much more volatile than what we see now. Uh, Also, because we have developed now futures and option system, and which gives a lot of cross hedging to the markets. But just see 58% drop that came here uh, in 2001, and then you had a 22 months of range going from 2001 to 3. So this was essentially some uh, you know about just less than 2 years of where you would be totally despondent that 5 years spending this in the range and then just popping up and coming back to the lower end of this rally. And then from 2003 onwards, you had a 63% move in just 6 months. Just 6 months, you were able to go back to this high uh, in 2004. And then, of course, the India shining BJP lost election, and we had a sharp crack of 32% coming down here. Now, imagine you had a crack of 32%, almost equivalent to, I think, the COVID crash recently. Imagine that coming through, and then immediately after that, you had a 400% rally. So from 40 to 50, virtually there was a unstoppable rally till January 2008. Of course, there was one big correction of approximately 20%, 22, 23% here. But this move was pretty much singular move, which happened from approximately 4,000 odd Sensex levels 4,200 to 21,200 levels. I'm using Sensex here because I wanted to go back to 1980s where Nifty was not available. So just imagine, a move like this uh, coming after a almost a decade of not going anywhere. So almost a decade from 1992, and of course this was a minor high here, but then the big move came after a decade. So after a huge bull rally, there will come a major part of consolidation. And after this huge bull rally, there was a huge correction by the great financial crisis, where Nifty and Sensex dropped 64% within a matter of 9 months. So, what took 46 months, 400% to achieve, 64% of that was given up within no time. But within the next 2 years, it did recover back 174%. So by 2010, you were still again at an all-time high, even though you suffered one of the worst ever drops in the market. But within 2 years, you were at the top again. So the time, if you have seen so far, the time spent in coming down is very very quick, and there are some range markets where there can be more time spent, but a lot of time is being spent in trending up. That has been the significant part of this entire journey. And then of course you had from 2010 to 2013-14, you had a ranged period here where the market chopped around, and you spent till 2013 before the emerging market rally again started towards 2015, right here. And then there was a global slowdown, and there was demonetization, and then another rally started from 2016 or 17 onwards. uh, 2015 to 17 I've taken as a range, not making new highs. And then this rally happened here till about 42,000 of about 42%. And then another sharp correction of about 39% at COVID times, and then 143% gain. So 143% gain that we have seen from this recent low into 2020 is really not out of the, you can say, the course material of last 42 years. 143% has happened many many times. If I just go through this list of nearly 100% gains, there's a 94%, there's 163%, there's 100%, there's 95%, 380%, 116%, 400%, 174%. So it is not that this rally is something very unique that has happened once in a lifetime only. It is happening in front of you every so many years. Maybe like every 4 or 5 years, we are having a huge big rally. And after every big rally, we also have a significant correction post that, and a range bound service. So there is no need to be very despondent about having missed this rally if you have. And the current setup since 2021 October has been extremely range driven. Uh, while we did make a minor high here, but I think since October 21, we are pretty much in a range, and we are buying time for earnings to catch up and for this gain to be consolidated. And once that happens, you will have the next jump because the economy is growing. uh, so just to summarize here, you had let me just go back to the slides and you can see it better there. So if we summarize this, then what is the insight that we can get is that 45% of the time we have been in an uptrend. So you can expect that about 45% of the time in the market you will do reasonably well, where if your strategies allow you to ride the wave up, you will get the benefits of that. Only 14% time is spent in the downtrends. So from time factor wise, not much time is spent in the downtrend, and 41% time is spent in more or less some range bound markets, maybe within 20% sort of ranged is there within that period. Average returns in uptrends are 142%. So every time you hit a uptrend, the average return is 142%. Every time you hit a downtrend, the average downtrend is 46%. And in the range, maybe about 7% is the average gain that we've seen, the way we have defined these ranges. Now, in terms of durations, the average duration in an uptrend is 1.5 years. So you will have 1.5 year of uptrend, and we have seen exactly that in the COVID run also. That from March 2020, exactly for 18 months, we went up till October 21. So 18 months of uptrend we had. Uh, Downtrend of 10 months. Here we had a downtrend of only 3 months here. Prior to that, the bigger downtrend we had was in 2008, and then we had a downtrend here in 2010-11. Then we had a downtrend in 2015-16. So most of these downtrends were limited to less than 1 year uh, of of a downtrend. And then of course you could have some periods of lull where you had 2.5 years of lull going around. And the current range we have spent approximately 16-17 months. So we are in a good second half of the average range. And maybe a few more months here, I don't know, maybe we start breaking out from tomorrow. Like, I can't say on that, but this gives you a reasonable picture that one cannot really look back and see what was the major trend in the previous months to juxtapose what is going to happen tomorrow. You will have uptrends, you will have downtrends, you will have ranges, and they will keep switching from one to the other. That is what is has been evident in the last 42 years of data. You have seen that there is a no strict pattern also, that you will get a uptrend and then you will get a range and then you will get a downtrend. But what you will see usually is that after a range you will get an uptrend. You will not find that after a range you got a downtrend. Either you will go up, crash down, and a range, that is consolidation, or you will go up and you will go range bound and then you'll go up again. That is usually the case. These are the two major cases that will happen. So my sense is that we are in the second case where we went up. Now we are doing a range bound market, sideways market, and then at some point we should start to go up again. uh, so this is something that I wanted to share with you. The conclusion here is that long downtrends and range markets are part of the game, and self-correcting nature of the index. So this is very important, that we've studied the index here. So what has the index done? Index has changed its constituents tons of times in the last 42 years. What was in part of the index 40 years back was not part of the index 30 years back, was not part of the index 20 years back. Some stocks, yes, but most stocks, no. I mean, just to in the last 20 years, we've had Jayaprakash Industries in Nifty, we've had Yes Bank in Nifty, we've had India Bulls in Nifty. I can rattle off a lot of other names also that have come and gone from the index. So the index needs to be a self-correcting instrument that you are following, or you have a strategy that is self-correcting, something like a momentum strategy. So the bottom line is, those who will play the long game according to the strategy will get rewarded, and that is the sort of the extract from this study that I want you to draw. So this is the end of this daily bite. Yes, a reminder that the Wild program is on for weekend investing subscribers. As annual subscribers, once you complete your first year, you are automatically applied a discount for your second year. If when you complete your second year, you're automatically discount added a bigger discount for the third year. The idea is to make sure that you stick with the strategy for the long term, to make sure that you get a trending period within your span of your subscription, so that you can make the best use of that momentum strategy. So thank you so much. I'll see you in another video. Please do keep sharing these videos with your friends, and I'll see you tomorrow. Yep.